All right, hey there everyone. This is another video lesson here. This one is going to be only about back testing, okay? So if you have any interest in watching how I back test and hearing my thoughts about, back testing option strategies, listen up. And if not, that's all that this one is going to be about, okay? So just wanted to let you know that up front. Back testing is something that I think is done so poorly and incorrectly for the vast majority of traders. Whether you're an options trader or a forex trader, if you have the capabilities, if you have either the software or the technology to go back and back test strategies, I think it's a very small percentage of traders who do it with a proper mindset. And let me explain to you why I say that, or let me tell you why I believe that. And again, my opinions, my thoughts, this is just from what I've experienced, and you certainly don't have to agree with me, but these are just, my thoughts and my feelings about backtesting from what I've seen. If we're looking at this chart right here, everybody can identify different points on the chart where the market turned, right? I mean, swing points, they're called swing points for a reason. Are we getting to one up here? Who knows? Are these areas that I've drawn circles around identifiable swing points? Absolutely. Do you have the benefit of knowing about those in real time? No, of course not. Do you have the benefit of knowing about these in back testing time? Of course. So I think there are a lot of obstacles and challenges with kind of curve fitting your back testing models to fit your methods that you trade, okay? And let me just step through one specific example what I'm talking about, okay? If I am going to trade a directional call debit spread, meaning I want the market to go up, okay? And let's just say that I just absolutely nail it right on the low, right here, all right? I have identified this candle right here, October 15th of 2014 of my date of trade inception, all right? So if I bring this over here, again, this is software that it's fairly expensive, but in my opinion, it's pretty mandatory. In the beginning, maybe not so much as you get deeper into it, but I still use it because I just, it definitely helps track positions. So October 15th, 2014, we'll go 10/15/2014, okay? So let's go to the end of the day, and let's just say that we have made a correct assessment about the market, okay? You'll see we have many choices of options in which we can buy or sell, and these are based upon expiration week cycles. So, I talked at great length in one of the video lessons about this time decay starting in at about 30 days to, expiration. That time decay accelerates a lot more rapidly than at any other point in time in an options cycle. So let's say that we come in right here at 37 days and we decide that we want to buy a call debit spread. If we come right at the money, 1070, and if we buy one and if we sell one, this is what the format looks like, right? We have defined risk. We are risking 1,000 to potentially make 1,000. It's a 1-to-1 R to R, okay? If we go farther out and we say, all right, I want to come out a little bit farther away. If the Russell's at 1072, well, let me come up here to 1,100. And if I buy one and if I sell one, that is a that is a call debit spread. It's a debit out of your account. You'll see it costs less money. Your absolute risk is less. Your reward is more. But the trade-off for that is the market has to move farther to become profitable. The red line is at expiration. So if you make a trade like this and you say that I have timed it absolutely perfectly, if I convert this in the software, then it locks those prices in and I can see what is my theoretical profit and loss as I start right here, as I either go up this curve or as I go down this curve, right? And so you can then step forward in time and you can say, all right, well, now in 1 day's time, I went ahead and I made $238 on a $662 investment. What are you going to do, right? Because of course, in Backtester, we can look at a chart and see that of course it rallied ridiculously all the way up here to 1170 before it started kind of tapering out, right? Well, if we know that it's going to go up to 1170, we know this is going to be a 100% winner, and we will have risked 662 and we would have made 1300, okay? But that's not real life, because in the real life environment, we don't know what's coming next, okay? So my philosophy and my take is, unless you have memorized every chart and every time period and key swing points, if you want to, as accurately as possible, back test how you think you are going to test in real time, then you need to randomly select points in time in the market and work through your strategy. Okay? If it's a directional strategy, if it's a non-directional strategy, just depending on what your method is that you are trading, well, then you need to do that so that you can say, all right, well, what's the emotion of me being up $238 in 1 day on a $660 investment? Who would not close that up in 1 day's time? Who would be so greedy as to try and hold out for a bigger trade? But yet, when you back test, you will see that, well, yeah, of course, because I know that the market's going up. But you don't know the market's going up in real time. I think that is really the crux of when you back test. If you are a intraday trader, well, then you need to only look at the intraday. This will step through in 30-minute increments based upon the market hours being open. And you will notice that you will see these prices, the market prices of these options, change. I mean, and they are really spot on accurate. I mean, they really are. OptionView has done a fantastic job with cleaning and scrubbing and filtering all this this data. So if you can trust the data being accurate on the option prices, if you can trust the data being accurate on the statistical historical volatility, well, then the last variable or the last element that you need to make sure that you can trust is your opinion and your sneak peeking at what the market's going to do in advance. And the way you get around that is by just randomly picking parts on the chart where you have no idea what it's going to do. Because, you know, we can all see that if we would have put a trade on right here in January of 2012, well, these are weekly candles. We see that it did absolutely nothing but traded sideways for almost 9 or 10 weeks, 11, 12 weeks, however many candles that is. But if you look at this swing point here, you can see that it was pretty much just a nice solid trend from, you know, 760 all the way up to 1200. I mean, the biggest, giantest, massivest trend on the major indices was in this Russell in 2013. This was a very difficult year to trade for non-directional type traders. This was a fantastic year to trade. Okay, so you have to you have to back test how you would trade in real time. Okay, so one specific case study that I'll walk you through and I'll show you. This is, you know, one way of trading and testing these charts. We can just pick, one second here. All right. Sorry, I had to take that dumb phone call. I forgot to put it on vibrate. Anyway, so let's just pick any period of time on this chart here, right? I mean, completely at random. We will say, you know, we can go all the way back here. I mean, we can go back 5 years. We can see what the market was doing like back in here. I mean, you can see obviously this is 2011, and you'll see, you know, the crash of 2008. Let's not please forget how volatile these markets can move. So, you know, just because we have been trading in this for the last couple of years, you know, if you look at the size of these candles in a period of days compared to this, right? I mean, you have got to be prepared. Anything can happen at any point in time for any reason whatsoever. And trading through this was not fun, but I will tell you what was even less fun was May in 2011 was, which day was it here? Was it that, you can see it better on the Dow. In 2011 when we had, was it May 6th? When was the day where it had the big spike? Was this the day? The flash crash. Anyway, it shows up. I will find that and I will show you. So see, now I am, it was May, is it this day here? I think it was this day. May 8th. So let's look at May 8th. Actually, let's do this. May 8th, 2011. Nope, it was not May 8th, 2011. Anyway, when it had the, you know, massive, you know, spike there. All right, you know what? Now, 2012. Oh, that's why, May 8th, 2010. There we go. Okay. This day right here, right? When we had this big range, you know, 1350, 1335. Russell was. That's what I'm looking for. So sorry. Good grief. May 6, 2010. Okay, so, boy, wasted a lot of time. I'm so sorry. If you look at this right here, all right, you have got a range from 701 to 637. You've got, you know, a gigantic range in which this market moved. So the reason why I really want to bring up some of these bigger moving days is if you are discussing back testing and you are only looking at end of day data, then you have got to ignore all of these wicks that hang below the lows of where the market closed. Okay, so then you essentially begin to look at a style chart type line. Then you begin to look at this kind of a chart, okay? And if you are only going to be back testing off of end of day data, well, that's what you have to be prepared to do. You cannot go back and say, how would I have traded to, you know, the flash crash in 2010 when your position may have hit a max loss, but then yet it recovered and it ended up closing right up here 40 points higher. You have got to be prepared when you back test to trade exactly in simulated environment as you would in real environment, okay? So let's just take any point in time here. I promise you I have not memorized what the Russell intraday swings are. let's just say we want to go January, I don't know, 6, 2012. All right, if we say that's a Friday and we have 42 days to expiration, okay? This is how I back test. I will show you one method, one strategy that we'll talk in much greater detail about. But let's just say I have a non-directional, I want to stay neutral to market, and I want to come in, the Russell did not move very much, and I've got 42 days to expiration, and I want to construct a trade that's going to cost me $1,000, and I want to make 10%. Okay, those are my assumptions right off the bat. I want to make $100. I'm willing to lose $100 to do so, and I will spend no more than $1,000. If I come right here, and let's say I want to come right at the money, 750. Let's say I do four here. Well, that's way too many. So let's just say one. All right, so that's $1,000. This is my risk profile. I know that there's this much potential profit. There's more than $100 in this trade right here, because you'll see that it ranges anywhere from 727 to 780, and the peak profit is $1,035. So I want to make 10% of that. So for me to back test how I would trade live, I convert the trade. This is what I do. This is my real life monitoring the market when trades are on. I watch it right at the open. I will not make ever an adjustment at the open unless it's in crash profit or capital preservation mode. And you'll see it didn't crash, so I automatically go to 1 hour after the market has opened. I will never make an adjustment in the first hour of trading. It has to be a very, very atypical set of circumstances. Okay, so right off the bat, where am I at? I'm down $50. Okay, so is that within my parameters? Yes. Did the market move anywhere? No. So now I don't watch the market intraday, and I don't watch every tick of the market that goes by. So I will scan to the end of the day, to 1 hour before the close. And I will see, what is my position doing? Well, now I'm down 37. I will go right to the close. What happened at the close? Did anything need to happen? Was I in any danger of losing this trade or closing this trade for profit? Nope. So what do? I repeat. I go to the next day right at the open. Okay. And I see, well, now I'm down 62, but the market moved 10 points up. Now, if it keeps moving up, I'm going to rapidly hit my maximum loss, and I'm going to have to close my trade. But I'm not going to do that in the first hour. So, same thing. I go right to the hour before the close, see what the Russell has done. All right, I haven't hit my maximum loss yet, and then I go to the end. So you'll see this is a very systematic. I am not looking at price chart. I am not looking at what happened. I am using the data for the options based upon my assumptions of perfect risk management. All right, and look, you'll see even just in that last hour, you went from being down $57 to at the close, you're down $12. Okay, go to the next day. 7:30, Wednesday morning comes along, and you'll see that you keep stepping through this process, because this is how I trade my live positions. So you want the process of how you backtest to mirror and match your live trading as much as possible. And I think what ends up happening is so few traders actually do that or take that so serious that they backtest incorrectly, and they have curve fitted backtesting results to be the optimum. And then when the real life trading comes along and they try and trade in real life how they backtested, guess what? The two do not correlate at all, and they are so far off. And so then they start saying, well, maybe my methods are screwed up. Maybe this is not going to work, and maybe you start down that path. And this is just my opinion and how I trade and what I've learned over the 9 years of being in this crazy market, trading options. This is how you put the odds and the edge in your favor of options trading. All right. Again, my assumption at the beginning was I have no opinion on the market. I am a non-directional trader. I want to stay between 730 and 780 before I make an adjustment. I'm willing to lose 100 to make 100. That was my assumption right off the bat. So we knew that those parameters were identified. Well, so now you'll see what's happening. We're getting up to this upper edge to where now I am no longer unbiased or neutral on the market. And how do I know that? Because look at how big this number is getting. So what do? Do I make an adjustment now? Do I wait till the next morning? Do I roll the dice? I'm down $20 on 1,000, but now I'm starting to get very, very close to not being delta neutral anymore. And when you're not delta neutral, then you become a directional trader. All right? And look what happened. So the market dropped and it fell back into place, and I'm up $20. So you can see that that was the right decision to make by not doing anything. Well, what if I would have done something? Then you go through and you model that scenario. You'll see 8:30, 1 hour after the close, we're up $18. Nothing to do. Go to an hour before the close. Again, you're stepping through this process of testing exactly how you would trade in real life. If you can watch the market and you're prepared to make adjustments every 30 minutes, well, then you need to step through every 30-minute increments. If you don't care about what happens at the open and you just want to zoom right to the close and you want to see what happens at the close, well, then that's how you need to backtest. If that's in fact how you're going to trade in real time, live trading, then you step forward one day at a time. Now, that makes the testing a lot faster. Of course it does. But now, look at what just happened. We absorbed a 13-point move up, where what if we would have just looked at that at the morning? Would we have made an adjustment sooner, okay, when we're up $43 now? So we'll say, okay, the market's been open for an hour. We have a 7-point move up. Do I want to do something or do I want to wait? So again, these are all the kinds of questions you have to ask yourself while you're stepping through scenarios. And this will not, I promise you, this will not be the last time I have a conversation or discuss back testing, because it's so richly important. And now you'll see we keep going up. Now I'm back. I was down 67. Now I was up 59. Now I'm back down to minus 27, and I'm way out at this upper edge. So what do? Okay, it's time to make an adjustment. I know from real life trading, I would make an adjustment. So let's say I close this trade and I just come up right here again, or maybe I just come up to here. Okay, so I kept my theta positive. I went from -6 to -3, so I made that nice adjustment. I analyzed the existing trade, which looks like this. I analyze the adjustment, which looks like that. And so what you'll see, this is what it is currently. This is what the new trade is. So I can model what I would do in a real life situation. And again, I am nowhere near breaching my $100 loss, but now I am getting close to hitting my $100 target profit. And it's on a Friday. I've been in the trade 2 weeks. What do? Do you hold on and hope for retracement? Do you hold on and go in through the weekend and see what happens Monday morning at the open? Again, it's something that you have got to just continue to develop and practice and put the time in, so that if you go this route of spending a great deal of time back testing, when you make that step from back testing one way, now you'll see we're coming right back up again here. What do? Do I make another adjustment, or do I let it ride? Well, Knowing me, I would make an adjustment. I would do the same thing all over again. Okay? So again, now we're getting to the point we've made 2 adjustments. We're getting closer to these options expiring. I'm nowhere near hitting my maximum loss money. And now I have to start asking myself, how much more do I want to fight this trade? This is my thought process. This is what I think in real life. This is how I trade in real life. These are the conversations I have with myself in real life. So when you back test, you want to make that as close to real life as possible so that when you get into a real life live trade scenario, you don't freeze and not know what to do because you have spent, you know, many hours. Okay, well now I'm perfectly centered. I'm up $73. At this point, if I'm in a real trade that has performed exactly like this, remember, we've been in this trade now 3 weeks. 3 weeks is a long time to be in a trade to make $100. Who wants to do that? And now I've just given up all of that potential profit. And here's where I'm sitting. So what do you think I would do? I would close the trade. And that's what I would do. I would say, okay, this trade didn't work out. I had a convert the trade, and I would go reports. Oops, I have to do this. All right, now these are all, actually we have to do this. One other thing here, sorry. I have to reconcile each one of these trades. So we go, give them all the same number. And these are just quirks of option view. So lost $72. Commissions were total were $12. So I lost $60 plus commissions on this trade right here. Okay? And what happened? The trade opened on January 6th. It closed on February 1st. And let's just look at what the market did in that period of time. From January 6th, which was right here, to March 1st. So we went from 750, we had almost an 80-point increase in the market. Again, that was a random pick on dates to see, you know, how a back-tested trade would perform. And what did we lose? We lost $72. Lost $72 on a $1,000 trade. Am I happy about that? No. But you know what? Did I test exactly how I would trade it live? Of course. So that makes me very happy. Because let's just say, instead of taking that non-directional viewpoint, you go back in time and we were January 6th, right? Now, instead of taking this non-directional opinion and we say, okay, that's one part of my portfolio. I have sections for non-directional, I have sections for directional, I have sections for speculative, I have sections for aggressive. I mean, you know, you subcategorize this out. So on one of them, it's a wash. You lose 72 on 1,000. So, you know, what is that? How much of a loss is that? That's a 7% loss on margin. But let's say that I picked right here and I wanted to target 775. This area, this swing point right here, that was prior right here. This pivot point right here. Support, support, resistance. Say that I was convinced it was going to go up here to 780. Okay, well, great. So then maybe I'll construct a trade like this. It says, okay, now I'm going to take advantage of my directional opinion, and I'll say, all right, I'm going to really lean very, very bullish on this trade, and I want to just watch this every couple of days because I have a directional opinion on this, right? So if you run that right up until the end, February 1st, like we ended the other one, well, now your $800 trade is more than making up for the other loss, and you have ran way, way, way outside of this tent. So, you know, there are many, many pieces to back testing that a lot of people don't take the time to discuss and really talk about. I personally think that backtesting is very important, okay? But at some point, the backtesting gets put to the side and the live trading has to occur. And when you can make the backtesting match the live trading as close as possible, what will happen is then your live trading performs a lot better. And when you want to make little tweaks that you think are necessary because of your trade plan reconciling, then you can go back into back testing and say, okay, well, what about, let's try this little tweak, or let's try maybe instead of waiting till the first hour, let's do something right at the open, or let's only look at it at the close, or you can ask yourself all these kinds of questions that combine the real life environment with the back tested environment. And in my opinion, when it's all said and done, that gives you the best weaponry to make the best decisions in real time when the market starts going all over the place. Okay, so I'll close on that. I will put another one together, just kind of maybe showing some more back testing examples on different equities, and this will be something in weekly lessons that I fully intend and plan on showing you guys. And we can pick dates, we can talk about dates, we have conversations about different underlyings and how these options respond right up to earnings, right after earnings. I certainly don't want to leave the impression that you have to backtest to be successful at this. Absolutely not. Absolutely not. The only benefit to using software like this to backtest is it just helps you. You can sit down and 3 or 4 hour block of time and walk through a set of guidelines and method rules and strategies and accumulate, weeks, maybe even months of experience in a few hours to see how trades, perform. So anyway, way longer than I thought. I'm really sorry. I hope this was helpful to you. And, we'll have some more coming up shortly. Okay, so thank you so much.